Ladies and gentlemen, stop scrolling. What I'm about to tell you could change everything for the silver in your portfolio. We are on the brink of a price move so dramatic, so intense that history will look back on this moment and say that was the turning point. If you own silver right now, listen closely because in the next few days, everything could shift. The calm before the storm is about to end. I want you to imagine something with me. Think back to every time in history when something ordinary became extraordinary. When the value of something widely overlooked suddenly blew past expectations and rewrote the rules of the game. That's exactly what's unfolding with silver right now. This isn't theory. This isn't speculation. This is what happens when supply and demand collide with real global forces, and the price that had been quietly climbing suddenly explodes higher. Silver has literally surged into record territory, smashing through long-standing resistance levels and pushing prices well beyond what most would have called possible just months ago. Remember, silver isn't just some commodity sitting on a shelf. It's a metal at the intersection of money, technology, and industrial demand. It has dual roles, a precious metal like gold, but also a key industrial metal needed in solar panels, electric vehicles, EV electronics, semiconductors, 5G, emerging energy infrastructure. Every solar panel built, every EV electric system wired, every advanced piece of technology manufactured requires silver. That combination monetary and industrial demand creates pressure on the market that most investors underestimate until the price is already moving. So what's the reality today? As of this year, silver has more than doubled, over 120% gain a year. To date, alongside a broader commodities boom and strong physical demand, prices have climbed above historical highs, reaching figures that just a year ago would have seemed extreme to many investors. This rally has outpaced not just expectations, but many other major assets reflecting deepening structural demand and tight supply conditions that are now impossible to ignore. Let me be crystal clear. This isn't a normal rise. This is what happens when markets start pricing in real shortages, not just future hope, and when multiple forces align at once. For silver today, inventories are tight. Registered stocks on major exchanges have declined significantly, and physical holdings are being absorbed faster than new supplies can be mined or recycled. London and Shanghai vaults are drawing down. The physical availability of refined bars is shrinking. When the metal becomes harder to get in physical form, markets begin to reflect that hard reality in the price fast. What's driving this? A combination of macroeconomic and structural factors. First, expectations for lower interest rates, or at least a period of monetary easing, weaken the opportunity cost of holding precious metals rather than cash or bonds. Central banks signal a shift in policy that favors softening rates or continued liquidity. Traders and investors begin reallocating into real assets, hedges, and tangible stores of value. That dynamic has helped push silver prices higher. Second, industrial demand isn't slowing, it's accelerating. Energy transitions are underway globally. Nations are building solar capacity at rates never seen before. Electric vehicle adoption continues to accelerate. Data centers, storage tech, semiconductors, and AI infrastructure all consume significant amounts of silver. Unlike gold, which is primarily a monetary metal, silver is also a critical industrial input, and those demands have exploded. Third, geopolitical tensions and market volatility have driven safe haven interest into precious metals. When equity markets wobble and global uncertainty rises, investors historically have shifted into assets like gold and silver. But silver brings an extra edge because it has both industrial utility and monetary appeal. That's why this rally has been so intense. Silver is outpacing gold right now, not by a tiny margin, but by very large percentages, reflecting a unique convergence of forces in the market. And fourth, speculative interest has amplified the move. Once silver broke through key resistance levels, momentum traders, hedge funds, and algorithmic strategies jumped in, accelerating the rise. Short squeezes and momentum flows often push prices beyond what fundamentals alone would dictate, and that has been a part of this rally as well. You see it with the pace of gains and how quickly prices have soared. Now, Current levels aren't just strong, they're historic. Silver is trading at levels it hasn't seen in decades, approaching and eclipsing records that were thought to be stubborn ceilings. These new price points are forcing investors, institutions, and even everyday buyers to take notice, because once something moves like this, it changes market psychology. Breakouts like silver's are not quiet, they shift the narrative. But here's the part that most people miss. A rally of this magnitude doesn't happen in isolation. It's the product of true scarcity in physical supply, rising industrial consumption, macroeconomic trends pushing money into real assets, and a shift in investor behavior toward metals viewed as hedges in uncertain times. When silver starts moving on all these fronts at once, you get a feedback loop. Rising prices draw more attention, which brings more buying interest, which tightens supply even further, and that pressure gets reflected in higher and higher prices. Let me tell you this plainly in every major boom in history. The markets tell you before most people listen. You can see it in price action, volume, and the speed of the move. Silver's rally isn't just strong, it's dramatic by historic standards. And because the market for silver is smaller and more volatile than, say, gold or large equity indexes, its moves are amplified. That means both opportunity and risk expand quickly. So when you look at how far silver has come, how quickly it's risen, and where it stands now, you're not just looking at a price, you're seeing an inflection point. That's the moment in history where something transitions from being underrated to unignorable. Right now, silver isn't just on the market's radar, it's dominating it. If you think the silver rally we've seen so far is impressive, buckle up, because what's coming next could shock markets and reshape how everyday people think about this metal forever. Right now, silver isn't just doing well, it's behaving like a rocket on the launch pad that's already lit its engines. The price has climbed to historic levels, and the near-term outlook suggests that this is not the end. It may be the beginning of something much bigger, much more powerful, and potentially much more dramatic than most investors realize. To understand why this is so important, you have to think in terms of forces, not just numbers. There are long-term structural trends pushing silver higher. And then there are short-term catalysts that can create explosive price moves in a matter of days or weeks. When both of those things align, markets don't just trend, they surge. And right now, that's exactly what we're observing. First, the supply and demand fundamentals continue to support bullish forecasts. For years, silver has been in a structural deficit, which means that demand has outpaced supply consistently. This isn't speculation. This is the result of data compiled by industry analysts showing a multi-year shortfall in silver production versus consumption that not only persists but deepens over time. That means, in plain language, is that there simply isn't enough silver being mined or recycled to keep up with how much is being bought and used. And that deficit matters because when physical supply is tight and demand is strong, price forced higher, that's a basic rule of economics. Now add to that the fact that silver is not just a precious metal, it's also an industrial metal of strategic importance. It's critical in technologies that are being built out at unprecedented scale. Solar panels that generate clean energy, electric vehicles and the batteries that power them, next-generation electronics and data centers, and emerging technologies that require silver's unique physical properties. These sectors are not slowing down. They're accelerating, and every ounce of silver they consume removes that metal from circulation and places it into long-term use, strengthening the imbalance between supply and demand. Against this backdrop, forecasts for silver aren't timid. Some models, including algorithm-based technical forecasting tools, show the price of silver could continue upward for the next several months, potentially breaking through current peaks and establishing new psychological support levels as the market digests this historic rally. One forecast even shows a possible climb toward higher figures by the end of the year, reflecting the sustained momentum and price action beyond what we've already seen. And let's talk about that momentum, because momentum in markets isn't just about price history. It's about market psychology and perception. A metal like silver breaks long-held record levels and does so under conditions of broad economic awareness. It starts attracting attention from institutional investors, hedge funds, and even algorithmic traders. That attention turns into capital inflows, which creates feedback loops. Price rises attract more buyers, which pushes the price higher, which attracts even more buyers. That dynamic can create sharp, rapid upward moves that feel more like shocks than slow climbs. This is where the concept of a Nardum price shock becomes real. In the very short term, markets can overshoot technical targets, driven by momentum and short-term positioning. Traders watching resistance and support levels can trigger cascades of automated buying or selling when certain thresholds break. With silver hovering near key psychological and technical price levels, even a small shift in market sentiment triggered by macroeconomic news, central bank actions, or changes in interest rate expectations could unleash a sudden burst of upward volatility that feels like a price shock to those who aren't prepared. Add that the fact that silver markets tend to be more volatile than gold due to their smaller size and lower liquidity, meaning that price swings can be larger and more frequent. When momentum meets tight supply and big institutional interest, the conditions are ripe for fast moves. This is not hypothetical. Markets have a long history of experiencing abrupt spikes and corrections when conditions align, and silver has shown this behavior before. But here's the twist. Volatility introduces risk. It also introduces opportunity. A price shock doesn't mean only a sudden drop. It can also refer to a sudden rally, a sharp, unexpected climb that forces those who were on the sidelines to rethink their positions overnight. When supply is constrained and demand is surging, and when speculative momentum enters the market, prices can accelerate faster than mainstream forecasts anticipate. Some independent analysts even suggest that under certain conditions, silver could test levels that were once considered out of reach just a short time ago. Whether these scenarios unfold exactly as predicted isn't guaranteed. Markets don't come with certainties, but the underlying forces driving silver are real. Physical demand, structural deficits, rising industrial use, macroeconomic shifts toward real assets, and technical price dynamics all point toward a scenario where the metal continues to surprise even seasoned investors. So when you hear talk of a potential near-term price shock, it's not fear-mongering. It's the honest recognition that when strong fundamentals collide with momentum and shifting investor psychology, markets don't move in neat lines, they move in bursts. And right now, silver is in that explosive zone where the next few days or weeks could define the trajectory for the next several months or even years. For anyone holding silver, whether physical bullion, ETFs, coins, or mining stocks, understanding this environment is crucial. This is the stage where big moves happen, opportunities emerge for those who are prepared, and where volatility properly understood can become a catalyst for gains rather than a source of fear. In the days ahead, watch the price action closely. Watch how markets react to macroeconomic news. Watch how technical levels behave, because silver isn't just moving up, it's charging toward a potential breakthrough that could feel like a shock to anyone who wasn't ready for it. That's where we stand today, poised on the edge of possibility, and the next few moments in this market could surprise a lot of people. When you think about silver, and especially when you look at where it stands today, you must understand one thing above all: this metal doesn't move like conventional assets. Silver is famous not just for its upside moves, for the violent, unpredictable swings that can happen without warning. And right now, as silver prices sit at or near record levels after an extraordinary rally, that volatility isn't something abstract or theoretical. It's the heartbeat of this entire market, threatening both fast profits and sudden risk, often within the same trading day. Why is silver so volatile? The answer lies in its unique position. It's not purely a commodity, and it's not entirely a monetary metal. It's a hybrid. It's industrial raw material demanded by cutting-edge technologies and energy sectors. And it's also a store of value that investors flock to as uncertainty rises. That dual identity makes its price capable of rapid acceleration in one direction and just as quick reversals when conditions shift. Simply put, silver's price sensitivity is much greater than many other assets. It's useful to visualize silver as a smaller, tightly wound market compared to something like gold. Gold enjoys deep institutional backing. Central banks hold it. Governments count it as reserves, and large financial institutions are comfortable allocating to it. Silver doesn't enjoy that same level of structural support. Its market size is significantly smaller, and as a result, any large movement in demand or supply gets amplified. When investors buy, prices can shoot up quickly, and when sentiment turns, prices can drop just as rapidly. Right now, silver has experienced a historic upswing that's drawn intense attention, then doubling in price in 2025, hitting levels that few would have predicted just a year ago. But that meteoric rise carries a catch. The higher you go, the steeper the potential fall. History has shown this again and again. When prices soar rapidly on strong momentum and broad attention, that same momentum eventually swings the other way, sometimes ferociously. One reason for this is market psychology. Traders and investors are not always rational. When prices rise fast, fear of missing out pushes people in, driving prices even higher, which works until it doesn't. At extremes, a sudden shift in sentiment, a surprise interest rate decision, an unexpected economic report can trigger rapid sell-offs as market participants rush for the exits. That's the nature of investor psychology. In volatile markets, peaks come quickly and reversals come faster. Another element that fuels silver's wild swings is its market structure. Unlike most commodities where production responds to price signals over time, silver's production is relatively inelastic. Most silver is mined as a byproduct of other metals like copper and zinc. That means even when prices rise, supply can't increase overnight to meet demand. In good times, that pushes prices up in stress or downturns. It can create sharp pullbacks because there isn't a responsive supply cushion. Let's break down what this means in real terms. Silver breaks through key price thresholds like surpassing 60 all per ounce or jumping to record levels in local markets. You're seeing is not just a one-way move. You're watching a market that is lean, reactive, and hypersensitive. These are the markets where a single macroeconomic event, a major central bank surprise, a shift in currency strength or geopolitical tension can spark outsized reactions in price. Volatility itself is risk, and risk without a strategy can be devastating. When prices swing sharply, leverage positions can get wiped out. Stop-loss triggers set weeks earlier may get hit in minutes. Paper markets, futures, and options can exaggerate moves. In silver specifically, these swings are often much larger in percentage terms compared to bigger. More liquid markets like gold or major currencies, and risk doesn't only come from downside moves, it comes from unpredictability itself. A sudden spike can reset investor psychology. A sharp drop can trigger fear and contagion into other risk assets. With silver, because the market is smaller and liquidity can dry up in moments of stress, these moves are exaggerated compared to broader markets. That's why analysts often say silver is not for the faint-hearted. One day you could see large gains and the next large losses. There's another unique risk factor, the interplay between industrial demand and investment demand. Industrial buyers, companies that use silver in manufacturing, behave very differently from financial buyers. Industrial demand is tied to economic cycles, strong in expansion, weak in contraction. Investment demand, especially in times of fear, can surge on safe have flows. When these two force vectors pull price in different directions quickly, you get crosswinds in the market. Price movements that seem abrupt because they reflect very different underlying motivations. This volatility is further intensified by currency moves, especially the strength or weakness of the US dollar. Since silver is priced in dollars, globally, sudden shift in the dollar's value can make silver more or less expensive in other currencies, driving rapid capital flows into or out of silver markets. That means you're not just watching a commodity, you're watching global money flows react in real time. So what does all of this mean for someone holding silver today? First, understand that volatility is not a bug. It's a feature of this market. You can't divorce silver's upside potential from its capacity for rapid and dramatic swings. That is why many seasoned traders emphasize risk management, because silver doesn't give warnings before it moves. Second, know that price levels which feel stable, even record highs, can quickly become inflection points where momentum changes. Volatility is also where opportunity lies. Moves that feel sudden can create big profits for those who understand how to position wisely. The key is not to fear volatility, it's to respect it. Volatility rewards those who plan, hedge, and stay emotionally disciplined. It punishes those who assume that past performance ensures future stability. In silver, the risk of sudden moves is real. But for those who prepare, who watch price action closely, who understand the structural forces behind the market, that same volatility becomes a powerful force that can elevate gains and define opportunity in ways few other markets can match. In the end, volatility isn't just a risk. It's the raw material from which opportunity is carved. Right now, if you look at silver, not through headlines, but through the raw forces driving real demand, you begin to see something profound. Silver has shifted its identity from being just another precious metal to becoming a cornerstone of the global industrial revolution. This isn't abstract. It's math and physics and infrastructure, the physical reality of how modern technology works, and the economics of supply and demand. Silver is everywhere industrially, and the scale at which it's being consumed is staggering. Industrial demand for silver accounts for more than half of total global demand, making a driving force in silver's price right now. Think about what that means. Unlike gold, which is mostly held for investment or as a hedge, silver's role in industry makes it integral to the real economy. Solar panels, for example, the backbone of today's renewable energy expansion, require silver for their conductive properties. The Silver Institute reports that demand for silver in photovoltaic applications alone jumped dramatically and could continue to expand significantly in the years ahead. Solar power is not a nice anymore. Governments around the world are racing to deploy renewable energy driven by climate goals, energy security concerns, and cost competitiveness. Every new solar panel installed requires silver, and technological improvements like TCON and other advanced cell designs actually increase the amount of silver required per unit because they use more paste and conductive material to squeeze out greater efficiency. That's not just adoption, that's material intensification. Then layer in electric vehicles. EVs are expected to dominate global auto markets in the next decade. These vehicles use 2 to 3 times more silver than traditional internal combustion engine vehicles, often 25 to 50 deg per EV just in electrical contacts, sensors, and battery management systems. As global EV production continues toward tens of millions of units annually, each one of those vehicles represents silver demand that must be met repeatedly year after year. Now add digitization and electrification. Everything from data centers to 5G infrastructure to AI hardware. All of these technologies require silver because of its unmatched electrical conductivity. That means your phone, your cloud computing, your smart devices, they all contribute to silver demand. Even if you never think about it, none of this demand is small or marginal. According to industry reports, industrial demand for silver already represents a majority of total usage globally. That's a structural shift. Silver is no longer just an investment metal. It has become a strategic industrial metal. Now you combine that industrial surge with macroeconomic tailwinds, and the story becomes even more dynamic. On the macro side, we have a constellation of forces that lift real assets like silver. Expectations of lower interest rates or rate cuts tend to weaken fiat currencies and reduce the opportunity cost of holding non-yielding assets. When markets anticipate central banks easing policy, particularly in the face of slowing economic data, precious metals across the board benefit because money flows out of cash and bonds into tangible stores of value. That dynamic has been playing out as traders price and potential future rate cuts and a softer dollar. We're also living through persistent industrial supply constraints. Silver mine production cannot keep up with booming demand because most silver is mined as a byproduct of other metals That makes supply inelastic. It doesn't respond quickly to price increases even when prices surge. A decade of structural supply deficits where demand outpaces total production has eaten into inventories and left the market tighter than at almost any time in recent history. So on one hand, you have unprecedented industrial demand that is steadily increasing year after year. On the other, you have structural supply constraints that limit how much silver can be produced. That mismatch, that deficit, is one of the strongest macro tailwinds for prices there is. Economics teaches us that when demand grows and supply cannot expand, prices rise until supply and demand reach a new balance. That's why forecasts for silver prices have shifted upward as this structural imbalance persists. But it's not just pure mathematics or market mechanics. Geopolitical and economic uncertainty plays a role too. In times of global stress, whether due to currency devaluation fears, geopolitical tensions, or financial instability, investors seek out tangible assets. Silver is both an industrial metal and a store of value, giving it a unique position. In environments where confidence in paper currencies weakens, metals like silver often benefit because they are hard assets you can hold or trade physically. All of these macro tailwinds, monetary conditions, industrial demand growth, supply deficits, and risk aversion are converging in a historic way. This isn't a short-term cycle. This is a structural market shift. Silver's role in the global economy has been transformed, and as long as solar adoption continues to grow, EV production accelerates, and digital infrastructure expands, demand will keep rising. That's the backdrop behind the current price rally. Prices have already reached historic levels, and the logic suggests that they could go even higher. Not just because of speculation, because the physical metal is being consumed faster than it can be produced. That's the real industrial and macro narrative, and it's what creates both opportunity and risk for anyone holding silver today. What's happening right now isn't a short-lived fad. This is a fundamental shift in how the world uses silver, from energy systems to transportation to digital infrastructure. And that shift has profound implications for price. When demand and macro forces align like this, markets don't just adjust, they reprioritize. Silver's identity is changing. And anyone holding it should understand that they're not holding a dusty relic. They're holding a metal at the heart of tomorrow's economy. Remember this moment. When people look back, they won't remember the days silver was quiet. They'll remember the days it broke the silence with a shock. And if you position yourself wisely, you won't be on the sidelines. You'll be in the game. Stay sharp, stay informed, and most of all, stay ready.